Okay, we will get started. Thank you so much for joining us this morning. My name is Jenna Witherby. I'm one of the advisors on the team at 401k Plan Professionals. And our webinar today is all about stable value funds. If you are on a 401k committee, you are at least somewhat familiar with a stable value fund, but there's actually a lot that goes into them, and they're very complex. And we have some really great content to bring you today on this particular investment class. We have our webinar series we've been doing for the last few years, and each month we focus on a topic, just a variety of things, not just talking 401k, but overall financial wellness. We just have a wide variety of different things that we've discussed and brought in partners and experts in addition to myself and my team members. And these are pretty short, typically 30 minutes or less. This is one of our last webinars for the year, but this recording will be out on our website. It'll be on our YouTube channel. It'll be distributed to you via email. Feel free to rewatch it, save it, share it with others that you think may find value in it. And likewise with all of our other previous webinars, they're all out there on our website, YouTube channel, or just ask myself or one of my team members, and we can point you in the direction, give you the link to rewatch anything. So we have an expert here with us today in the stable value space. Today's presenter is Fred Spreen, and he comes to us with a lot of experience in the financial services industry. Right now, he's responsible for the Midwest division for the stable value investment only division of New York Life. He also has had experience with being the DCIO specialist for New York Life Mainstay Investments, being a regional vice president with Wells Fargo Institutional Retirement and Trust, and then also with Prudential Institutional Investments. So thank you so much, Fred, for being with us here today. I know that this will provide a lot of value for those today that watch it live, and I know this is one we're going to definitely revisit in the future. So I will let you go ahead and share your wisdom with us.
Great. Well, thank you very much. And I'm happy to be here. And hopefully everybody will get something to take away from this. Stable value is a little bit of a tricky asset class, and hopefully we can clear some things up for folks. So just a brief agenda. We're going to go over the basics of stable value, talk a little bit about stable value and the markets, past and present. Talk about some due diligence, providers, investment information about stable value, and then importantly is contract provisions. And then we've got a little bit of resources for you to check out on your own time if you'd like to learn more. So we'll start out with why stable value investments inside of a 401k plan. Certainly capital preservation is top of mind these days with the markets being as volatile as they are. So capital preservation really comes into to play here, and the importance of it. So the goal of stable value is to preserve your principal, get a little bit of interest as well, and then make those returns as consistent as possible. So less volatility, like the name, stable. You want it stable, like stable value. So cash-like liquidity for participants, so they can move freely in and out of stable value without any penalties or fees. That's different for plan sponsors, but for the participant, we call it benefit responsive. And then higher potential return than money market funds. And we've got a slide that will kind of point that out and make it really obvious, especially as money market rates are finally starting to move in the right direction, where they're a competition again for stable value funds. So on the risk investment risk spectrum, money market funds are considered safer and more liquid than stable value funds because of some of the rules, but stable value funds are considered less volatile and less risky than a bond fund. Stable value funds are a core investment in DC employee benefit plans, 401k, 403b, 457, 401a type plans. Nearly $1 trillion invested over the past 40 years. And there are 206,000 DC plans that use stable value, and/or it's approximately 75% of plans hold a stable value fund in them. They also may have money market in them as well, and we'll talk a little bit about that feature. So your expectations when if you don't have a stable value plan in your fund right now and you're considering it, what are some of the expectations you should have for your stable value fund? Again, capital preservation, most important. That's what we strive to do, is make sure that your capital is safe, and then you're getting something in return, with your investment. So you're making investment like a CD at the bank almost. You want to get your money back plus a little bit of interest, and you want that return to be stable and what we call no surprises. So no huge swings in the rate, like a money market can do in a rising rate environment like we've got right now. And then competitive rates. Historically, we've outperformed the money market, stable value, and other short-term alternatives during the investment cycle. So not looking at any investment, over a 6-month or 1-year period, but really looking over, 1 year, 3 year, 5 year, 10-year period, and then looking at volatility, looking at returns. Crediting rates generally track current interest rates, and they'll lag for stable value. So while money market, you'll see an instant, if the Fed raises short-term rates, you're going to see a boost in money market rates immediately that following day, whereas stable value, because of the duration of the portfolio, if you think of money market, it's a very short duration. So 30-day, 60-day, 90-day bonds or treasuries are inside that portfolio. Whereas in a stable value fund, the duration of your bonds are anywhere from 2 to 5, some go as far as 8 or 10 years, but generally 2 to 5 years is what most stable value fund managers are looking to stay in, to help ensure, again, that stability. And the longer you go out on the yield curve, the more volatile it gets. So you want to stay as short as you can. And potential diversification benefits for participants. Because of the low volatility and the consistent returns, using stable value inside an overall portfolio instead of bonds, which have what they call floating NAV, you're getting a steady, solid base to that portfolio, like called anchor to your portfolio, and allows you to be more aggressive on your equity portfolio in a model portfolio. Just a little review on the history of stable value and where there's been issues, and taking a look at the current environment. So in recent memory, going back to 2008, 2009, the financial crisis was the biggest test the stable value has really ever seen. You had stocks and bonds, both in bear markets. You had money market funds that broke the buck, so to speak, where they actually lost money. You had stable value funds that some that closed altogether and liquidated because they were taking such losses, and/or lost what they call wrap providers that provides that guarantee inside the portfolio to be able to transact at book value for participants. They were taking such losses during this period that they ended up losing some of their stable value wrap providers and had to either close the fund down or stop taking in new money to be able to handle those redemptions. Some stable value funds, if you remember the TARP program, stable value funds participated in the TARP program. Most stable value funds or companies took money to shore up their stable value funds, which we think, kind of saved the stable value business during this time. Because if you think back, Lehman Brothers went under, and it was the only stable value fund that actually lost money during that time. Everyone else that either closed or had a soft close, and all the CITs for the most part went through that, where they stopped taking in new money, and insurance companies actually all stayed open during this period. Companies like New York Life, Prudential, and others that are large players in stable value, we can't close our funds. The way that they're structured, the insurance structure, makes us really stay open. So we took in over $1 billion as Merrill Lynch stable value closed, Schwab, Lehman, and a bunch of other ones. So insurance companies stayed open. We actually took the brunt or the bulk of the monies that were available during that time. And we've never been closed, and I'm assuming that we'll never will close unless something really catastrophic happens. Increased scrutiny happened after the financial crisis. You saw money market rules change. There were some changes inside of the wrap agreements themselves, because some of these insurance companies and banks took such losses, and they said, this is not a core business for us, so we are exiting, and licked their paws and went back. A lot of those companies are now back in the business, and we're seeing, what they call wrap capacity really improved and pretty healthy right now. The current environment, as you all know, we hear every day, lots of inflation out there, and interest rates are rising, volatility in equity markets, and there's been a flight to quality. So we're seeing a tremendous amount of cash flow into our funds right now. When we finally see some capitulation in these markets, we think that we'll see even more cash flow. So we're preparing our portfolios for that. And, I'll, without tooting our own horn, so to speak, I would say that that folks are really, portfolio managers are trying to get their duration of their portfolios down. All of the good action on the yield curve is on the short side of the yield curve, and so we're positioned. I could tell you that our fund, the New York Life Anchor Fund, is positioned at 1.98 year duration. So all the money that's coming in right now, if you've got a portfolio with a low duration, you're able to put that money to work in current interest rate environments, and in a raising rate environment, that's really where you want to be if you're a stable value manager. So a longer duration stable value fund is experiencing a little more hardship right now, as they have to wait for their securities to come due to be able to reinvest. The shorter the duration, the faster you can reinvest and take advantage of the current interest rate environment. So due diligence, we often find that this is the forgotten asset class. In many cases, folks kind of skip over stable value as their capital preservation. Oh, it's guaranteed, and that's the guarantee in our capital preservation option, and they kind of glance over it. In many cases, it's because it's maybe a proprietary fund at your record keeper, and that's all that they offer. And in many cases, there are not non-proprietary funds being offered to you by record keepers. So, at least semi-annually, we think you should take a look at your stable value fund and do some due diligence on it. Have your advisor, your fiduciary advisor, take a look and benchmark it like they do every other asset class. Treat it like any other asset class in your plan. And again, and reviewing more often during turbulent markets. We're recommending that everybody really should be taking a look at their capital preservation investment right now and doing some due diligence during your next investment meeting. So this is where it gets a little bit confusing for everyone in this business. Fortunately for me, I've been in the business for so long that it seems simple to me, but there's three basic structures of stable value. You have your general account, which is an insurance company that offers a fixed fund where They're offering you a declared rate every quarter or every 6 months or every year, depending upon the fund. You provide them, you give them the money, they take over the control of that money in return for your contract rate, which again is reset every 6 months, quarterly or yearly. It's a forward-looking rate, so they declare the rate and that's what you get. And the insurance company that holds those funds and those assets and owns those assets guarantees that you will get your money back plus the interest. That is what they call a GIC. It's the old school first stable value fund that was offered out there in the 1970s. Still around, still required to use in 403(b) plans. Secure Act 2.0 may change that, but as of right now, still a very popular option, still the best performing option out of all stable value funds. With the most restrictions, also comes with a 1% guaranteed minimum rate. So no matter what the rates are, and that came into play in these past few years where rates got so low that 1% was, in many cases, was your return because that's what your guarantee was. Then there's the separate account, which is also an insurance company product in many cases. And the assets again are held, but they're segregated from that general account. So one of the pushbacks against general account products that we just talked about are that your liabilities are all your eggs are in one basket. You're with one insurance company. The most important factor in reviewing becomes, how strong is that insurance company and what's their credit rating? That becomes, I think, the most important feature, especially when we're going into a market where there's uncertainty out there and it could get ugly. We don't know. But if it does get ugly, you want to be with an insurance company that's very strong, that's going to be able to withstand the worst of times. The separate account, again, it's a segregated account backed by the general account when it comes to the guarantee, but you've got a separate sleeve of securities that is managed by a portfolio and portfolio manager, and your return is directly correlated to the return of those assets inside of that separate account. Very popular, again, still guaranteed, but there is no floor. You're guaranteed not to lose money, but you're not guaranteed that 1% like you are in the general account. And then there's the synthetics, which we call CITs. They're held externally. The plan still owns the assets, different than separate accounts and general accounts, which are insurance products, where you're actually handing over the control and the ownership of those assets in return for your contract. And then you get that direct guarantee to the plan sponsor. So you have an indirect guarantee with these synthetic products. And the return is also based on the underlying performance of a different type of separate account. It's just a managed account with no minimum, and very popular. I would say in the last 20 years, they've really gained popularity because of the fact that they offer more diversification of insurers. So these CIT products will have multiple wrap providers. So you may see New York Life and Prudential and Transamerica as one of their wrappers. We're in both sides of the business at New York Life. We'll wrap many of these outside funds and be one of 5 or 6 or 7 or 8 wrappers. And then you'll see us in our own accounts where we actually manufacture the product and give you a direct guarantee. We're a little bit different than a lot of other insurers out there in that New York Life is the top rated financial strength insurer in the world. So now we'll talk a little bit about monthly returns and volatility and why stable value makes so much sense over the long haul, where you may see, right now or in the near future, after the next rate hike, you may see that money market rates become very attractive in the short term. But we ask you to really take a look in the longer term and understand that the idea behind stable value is to smooth out your returns and and decrease volatility. So the bond market is the gray line that goes up and down. It's the most volatile. Every day the bond market shifts up and down with rates. And then you'll see the green line is stable value, the most steady line that's out there. And then your red line is your money market. So you'll see there's more volatility in money market, and generally it underperforms stable value. I think, and I don't want to make any predictions, but I think you'll see stable value underperform in the short term money market rates if the Fed raises at the next two meetings. So you take a look at, again, at the long term, which is, when you're thinking 401k plan, you're thinking long term, thinking your participants are thinking long term, not set it and forget it, but take a look at where you would be. A dollar growth since 1988 in stable value would be worth $5.47 now, $2.37 in the money market. That's the huge outperformance. In the bond market, you would slightly underperform. For the most part, either very close or outperforming on a short-term basis the stable value fund. So stable value is the winner overall. Again, it's because of that steady return. Again, this just shows you the volatility of money markets. They've been really at zero for a very long time, and we're just starting to see. In 2017, we got a couple of rate hikes, and we went right back down to zero. And as you can see, the green line is always above the money market rate because it has outperformed pretty steadily over the past 25, 30 years. Right now, uncertain environment, you got a lot of market volatility. We're seeing a lot of cash flow because we're seeing folks get more conservative as baby boomers age. Stable value becomes a bigger part of their portfolio as they're looking to lessen the volatility inside of their portfolio. So we expect the demand for stable value to continue to be strong, probably cross $1 trillion in assets over the next couple of years. We expect that, some banks and insurance companies, could exit the business again if times get tough. Guaranteed business is generally more in line with an insurance company than it is with a bank or an investment firm, because guarantees are core to what we do at insurance companies. And then we've seen some really increased fund consolidations in the stable value world, something we haven't seen in, more than 20 years, where you saw Empower, or Great West is the parent company, bought both MassMutual's record keeping and stable value operations, as well as Prudential, who was the largest stable value provider in the business. As a former Prudential employee many years ago, I sold stable value there in the 90s when nobody else was really doing stable value. They were one of the few players, and they got to be the biggest player in the business. And now they've been acquired and are no longer a company that offers stable value for record keeping. Why would you review your stable value plan, or when should you review? It's your fiduciary responsibility as a fiduciary to your plan to advocate for plan participants' interest, to make sure that you're offering something that's the most competitive and the best for your participants. Really understanding the risks of stable value and the ins and outs. And again, that's where somebody like me or your advisor really comes into play. I would say that, in the 10 years that I've been at New York Life, a good 50% of what I do is speak with plan sponsors and really help them understand what they own today, how it works, what are the pros and cons of what they own, and maybe what they should be looking at, and then showing them their alternatives and letting them make those decisions. So that's a big part of what I have to do is education. Because there really is significant differences between funds, and really understanding. And I think it comes down to, for me, it's all about the exit provision. Everybody, it's easy to buy in. not so easy to get out, and understanding what the exit provisions are, we think is really most helpful. And again, every other year and or during turbulent markets, we think that you should be taking a look at this even more. So things that you should look at when you're doing your due diligence is what kind of company is backing this stable value fund? Are they a mutual company like a New York Life, or publicly traded insurance company, like a Prudential, or any other insurance company, a Principal or whomever? Mutual companies tend to have a longer term outlook. We don't have at New York Life, I can speak to us as we're a mutual company, we don't have shareholders. Our policyholders and investors in our stable value funds and insurance products are the owners of a mutual company. So we don't have quarterly earnings calls with analysts and have that kind of pressure to deliver earnings on a quarterly basis. We're, again, more focused on the long term. Taking a look at the strength, the underlying strength of the insurance companies that either wrap your product, or if it's a single wrap product, certainly you want to understand in a single wrap product who you're doing business with. And I always like to use the example again to New York Life that if everybody died tomorrow and we had to pay all of our insurance holders off the very next day, New York Life would still have $30 billion left over after paying everybody. And that's what gives us our AAA rating and financial strength ratings from all four, the highest offered by all four rating agencies. And then taking a look at who's managing those assets. Very important. Is it somebody new? Have they been in and out of the business several times and it's an opportunity business for them? Or is this a core business for that company? There are lots of good companies out there managing stable value assets that have been in the business for 20, 30, 40 years, like a New York Life or like a Galliard or a Prudential, that they're not new to the business. So we think that's important as well, to see all different marketing timing cycles. Other things to take a look at, you want to take a look at the crediting rate history, just like any other fund, comparing it to its peers. Again, the financial strength ratings, these are all things that you can take a look at. Again, like every other asset class, taking a look at historical returns. What's the average credit rating of the bonds inside the portfolio? I mean, do you want a junk bond portfolio, or do you want something that's investment grade? We believe in being conservative, and investment grade only securities should be in stable value. That's our take. Other folks have a different take, and you will see it in their, everybody discloses what's inside their portfolios. So again, something to take a look at. Duration, another thing that's very important. Again, in this cycle right now, you want to be short duration to capture the raise in rates. And then also take a look at not only the average duration, but what's the maturity distribution. They may have the duration of the portfolio may be low, but it may be because they've got a bunch of low, and then they've got a bunch of securities that are in there that have 10-year duration or 5-year duration. So you want to take a look at that too. And then the asset classes that are inside the bond market, inside your portfolio, it's not only treasuries, it's corporate bonds, it's mortgages, it's asset-backed securities. So you want to know what type of securities, what kind of diversification is inside of not only by company, but by bond type. And then the market to book ratio relative to others. You'll find that currently most stable value funds, the market value is less than the book market right now because of the bond rate environment. Rates are going up, prices go down, your prices are your market value. So most everybody is underwater right now, which has no effect on participants, but a more difficult time to exit a stable value fund than it would be in a good time. Other things to look at, your contract provisions. Know these provisions inside. These are things that really like I said, it's easy to buy a stable value fund, not so easy to exit them if you purchase the wrong stable value fund. So what are the limits inside of the plans? Are there penalties for withdrawals? What happens if there's a layoff or you get acquired or there's a merger? Stable value funds are notorious for holding things up, and prior planning and proper planning and early planning is one of those things. Bankruptcy is another one. What happens under a bankruptcy situation? And again, know those termination provisions inside and out. We always say that you want a product that really can tell you exactly how you're going to get out at book value. If it's a market value out only product, I always say there's no free lunch, and that you don't want to be handcuffed to your record keeper because of your stable value fund. You're not able to exit. You're not able to make it portable to somewhere else. And what else is there? Frequency of crediting rate. How does interest get credited to the account? Can you transfer funds inside and out? There are these competing fund equity wash provisions inside of these, so you don't play the interest rate game. If the interest rate is low in your stable value, but it's higher, and you offer a money market in the plan, you don't want people switching to get the higher rate, and then when that goes down, they switch to the lower one. So there's something called a equity wash provision, which makes them put that money at risk for 90 days. Again, look at costs like any other investment. And then challenges and opportunities. Certainly there have been lawsuits in the stable value world, participant groups that have sued plan sponsors for not having stable value because of the rates have been so low. If you look down the end here, since 2008, money market rates were really at zero. If you didn't have a stable value, you had missed opportunity cost. And this is why it's so important as a fiduciary to make sure that you're taking minutes at these meetings and discussing your investment options, like stable value. If you only have money market, that's fine. If that's which you just want to discuss it and take minutes so that if you do get audited or you do enter into a lawsuit, that you're not subject, or you've got the notes to back it up, the reasons why. And again, that's a fiduciary decision. You don't have to have money market. Monetary policy, market volatility right now. This is what's making it so important to really take a look at your stable value fund right now. We're expecting, as volatility rises, we're expecting to see incredible cash flows into stable value. Other resources, our website at New York Life is StableValueInvestments.com, where you can find videos, white papers, fact sheets, thought leadership, stuff that I've written and my colleagues have written is up there. The Stable Value is .org is our industry association. FI360 has a tool to compare stable value. And then LIMRA is another industry organization that takes a look at stable value as well. And there's some of the rules and compliance disclosures for everybody out there.
Thank you so much, Fred. Wow, you really covered a lot. And, as you were talking, I was thinking of these questions, and then you just answered them all. So there's a lot of value there, and for plan sponsors too, really great content. And for us, for committee meetings and in minutes, really, some of the things that we should be documenting and kind of lifting the hood and looking a little deeper in there. So thank you so much for all the value. Again, everybody, this will be recorded and it'll be out on our website soon, YouTube channel. You'll get an email. You'll also be sent a really brief survey. So that's really helpful for just getting feedback, getting ideas for the future, and seeing what you thought. And our next webinar will actually be my quarterly fiduciary training. I host that every quarter. It's great for newer committee members, somebody that has not maybe been through more formal fiduciary training. And so that will be November 10th, and you'll be getting an invite for that. closer to the date. But thank you so much. Again, if you have any questions, you can send them to myself or anybody on my team at 401k Plan Professionals. Okay, well, thank you, everybody. I hope you have a great rest of your day. Okay, bye-bye.
Thanks for having me.